Credit default swaps are a type of financial derivative that allow investors to protect against credit risk or speculate on the creditworthiness of a particular issuer. A CDS is essentially a contract between two parties, where one party agrees to pay the other in the event of a credit event, such as default, bankruptcy, or restructuring of a particular issuer. CDSs were first introduced in the 1990s as a way for banks to manage their credit risk exposure. Since then, they have become a popular tool for investors and traders looking to hedge or speculate on the creditworthiness of a company, sovereign entity, or even a basket of issuers. To understand how a credit default swap works, consider an investor who holds a bond issued by a particular company. The investor is concerned about the creditworthiness of the company and is worried that the company may default on its debt obligations. To protect against this risk, the investor can purchase a credit default swap from another party, such as a bank or hedge fund. In this scenario, the investor is the buyer of the CDS, while the seller is the party who is willing to take on the credit risk. The buyer of the CDS pays a premium, usually expressed as a percentage of the notional value of the bond, to the seller of the CDS. If a credit event occurs, such as the company defaulting on its debt obligations, the seller of the CDS pays the buyer the difference between the face value of the bond and the recovery value of the bond. The recovery value is typically determined by an auction process, where investors bid on the defaulted bonds. In some cases, the buyer of the CDS may not hold the underlying bond but may still purchase a CDS as a way to speculate on the creditworthiness of a particular issuer. In this scenario, the buyer of the CDS is essentially betting that the issuer will default, and they can make a profit if the credit event occurs. Credit default swaps have been both praised and criticized for their role in the financial markets. Supporters argue that they provide a valuable tool for investors to manage credit risk exposure and can help to prevent financial crises by spreading risk across the financial system. Critics, however, argue that CDSs can contribute to financial instability by creating a web of interconnectedness among market participants, making it difficult to determine who is ultimately responsible for the risk. Additionally, the complexity of CDS contracts and the lack of transparency in the market can make it difficult for regulators to monitor and mitigate potential risks. Despite these concerns, credit default swaps remain a popular tool for investors and traders looking to hedge or speculate on the creditworthiness of a particular issuer. The market for CDSs is large and diverse, with participants ranging from hedge funds and banks to insurance companies and pension funds. Credit default swaps are a complex financial derivative that allow investors to manage credit risk exposure or speculate on the creditworthiness of a particular issuer. While they have been both praised and criticized for their role in the financial markets, they remain a popular tool for investors and traders looking to hedge or speculate on credit risk. As with any financial instrument, investors should carefully consider the risks and potential rewards of using credit default swaps, and consult with a financial advisor before making any investment decisions.